Hi, everyone, and good afternoon. Thanks for tuning in to today's Market Color call. Before Jordi shares his thoughts, we would like to share our compliance department's thoughts, which are as follows. Weiss does not recommend particular stocks, bonds, options, derivatives, or securities of any kind. We do not guarantee any results or investment returns based on the information you receive. Although we have used our best efforts to provide the most innovative trading and investment strategies, the views presented today are forward-looking statements which are subject to change as circumstances change, and we cannot promise future profitability. If you have any follow-up questions after listening to the webinar, please reach out to Jordi or the marketing team. We would love to hear from you. A replay will also be available on our website. Jordi, the floor is yours.
Thanks, Amanda, and hello, everyone. I just wanted to give an update since a lot's gone on in the last few weeks since I did the last one. And I want to organize this in a way that hopefully you're getting some information that I think is both news, but also important. And much of what I'm going to end up talking about today is just where we are related to the economy and earnings, and focus a little bit again on this whole concept of inflation based on the data we've seen. So the first thing here in terms of the chart that's on the screen, this is the City Surprise Index for the US. The reason I brought it up, this obviously goes back to 2003. We continue to surprise on the upside in the data. So this is not just the trend in data, this is the trend in data relative to expectations. And so when I listen to people about the economy and where things are, they're still making proclamations for the most part on what it's going to look like going forward. At this stage, the number one focus for people relative to expectations for both individual investors, institutional investors, but most importantly, the government, the surprises have come back in a violent manner to the point where you have to be asking the question, which I brought up on a lot of these webinars, which is, how much is too much? Have we put too much money in the system and come back from the economy much faster than everyone expected? And what does that mean for assets? So right off the bat, the economy over the course since the last meeting has continued to accelerate. And that is an important part of this discussion. The most important data point that came out, and where I want you really to spend time on, is something I mentioned in one of the webinars. There's a lot of people that are focused on what's happening in travel, on vacations, in terms of hotels, restaurants, amusement parks, casinos. That ends up being the negative point that people continue to bring up. This chart here is the most recent personal consumption expenditures chart. This is the durable part of those numbers. So this is really fixated on transportation, housing, and recreational goods, anything that's basically durable or hard. So refrigerators, everything along those lines. And you can see that the violent spike we've seen in this has come in incredible fashion in the May reading, where we made up almost the entire fall. Now I want you to focus on what happened in 09. It took a long time in 08, 09 to actually get up to this point. In terms of coming back, you're talking about multiple years to get up to the same sort of rebound. So this has been far faster than what we could have expected on the durable side. This is it for furniture and household furnishing. This is it for motor vehicle. This is it for recreational goods. I want to highlight the fact that we had a jump basically from 380 to 470 in recreational goods. This will be RVs, ATVs, anything, trampolines, bicycles, anything related to being outside. Obviously, this has been a major focus, but the $90 billion jump in a month, if you take it from post Lehman Brothers, 90 billion took almost 9 years. So this is a very large change in behavior, but it's also something that people need to pay attention to. Now I'm going to show you the stuff that hasn't bounced back that people are focused on. So this is restaurants, obviously has not bounced. Then we start getting into what I consider the vacation or travel side. So this is air transportation, has not bounced really at all. You've got the casino and gambling. This is the amusement parks. And the reason I wanted to show these is when you combine those three along with the hotels and motels as one number, this is where you drop from 400 billion to 63. Now, to show you how unimportant this is relative to something as simple as recreational goods, this is on the same scale. So the total sum went from 400 billion for vacations down to 63. Recreational goods is already bigger than it was there. This does not include housing. This does not include motor vehicles. The dominant part of the economy for consumer expenditures is related to housing, it's related to autos, and all the things that get associated with it. So the fact that we are seeing large purchases in durable items, you're gonna see a bounce back in this that'll be gradual, that's true, but you're already making it on the durable side. And the reason that that is so important is this chart. This is that durable, that's the white line, relative to the S&P 500. So as long as housing and durables are going through, the S&P is correlated to that. The other components, the non-durable and service, historically, those have been the least volatile. The durable has been the most volatile, the most cyclical. The fact that we put this much money in, that rates are low, has driven the durable category. They're more sensitive to that. And that is why people should be more optimistic. I expect the durables to get through the all-time highs in the coming months because of the amount of money that's still sitting out there and how much the S&P has gone higher. And as people are going back to work, that would mean that the S&P is going to make new highs sooner rather than later. And I expect that very likely to happen based on a variety of things, which I'm going to show going forward. In terms of moving from the economy to the inflation side as an update, I talked about the impact that COVID would likely have on the supply chain more than the demand side. We've given people money. They're going out and spending regardless of the data that shows up on cases. But where it is having an impact and will continue to have an impact is on producing those durable goods and around the globe. And so what you have here is retail inventories for the month of May down 6.1%. That drop happened during a time, remember, that in May, the economy really is still down significantly, and most people, or majority of people, are still out of work from what had occurred. So that drop is important. And as I go through these, you'll start to see a theme that continues to play out. This is the new orders of the PMI, the orange line, which is all the way up here. We got up to a 56 level. The white line here is wholesale inventories. Now, what you notice back in Lehman Brothers, when we started to see this bounce, it makes sense, but inventories really get drawn down. So inventories were already low before the bounce, as I highlighted on the last one. That is very different than Lehman Brothers. A lot of that had to do with the tariffs last year in terms of people not knowing when to build stuff up. So inventories were already lean going in, and I expect that to continue to be the case. This here is the motor vehicle inventory. So this gets into the part that, again, motor vehicle inventory is at historic lows. So you have motor vehicle inventories at lows at the same time that there is increased demand for motor vehicles. And where we've really seen the motor vehicle spike is on the used car market. So used car prices made an all-time high in the most recent reading in June. This is the month-over-month change in that. So we had the largest gain in prices. So you've got a situation right now where you've seen the used car market really soak up a lot of the excess inventory that was there. So we have a drop in inventories. This is the food and beverage inventories continually still being at a new low, even though we're out of the part where people were hoarding food. What has shown up is the food at home inflation is still at the highest level since the 70s. So we are seeing food prices be high. This is the consumer confidence most recent reading. I showed this initially when it spiked up to 4.7 during the crisis. Here we are now at the highest level in 10 years on the consumer confidence 12-month inflation expectations. And to show you what is unique about this is that it's happening without gas prices or crude oil. So this is the yellow line here is the 30-day moving average of crude prices versus 12-month inflations. So the times where we've seen prior peaks have been driven by crude oil. That is not the case right now. Gas at the pump is still down significantly from where it was. Crude oil obviously is down significantly from was at the beginning of the year. So this is being driven in terms of people's expectations by other things they're purchasing. There are shortages of a lot of things out there, bikes, trampolines, cars are getting to that point. So companies are getting pricing power on the durable side, and this is feeding through to inflation expectations. On that side, in the non-manufacturing prices, which came out yesterday, this is the overlay with it versus the PCE deflator. So we still have the deflator down here, but you've already seen the non-manufacturing prices go back to the highest level since 2018. So you should expect to see the deflator going higher in coming months, with all the expectations going higher, but also the assets supporting it. This is my risk row index, which I've shown repeatedly on this. This combines the dollar weakness with commodities and stocks. And we've seen the risk row index bounce all the way back up to here, while the PCE deflator again is down there. This is the PCA deflator versus global earnings revisions. So earnings revisions, which are the white line, have gone up here. I think this is going to be a major theme, and this is where I'm going to spend some time. When people are trying to say that the S&P has gotten way ahead of itself, or stocks are being manipulated higher, or that Robinhood is driving it higher, the reality at the end of the day is when the economy surprises on the upside and you're beating expectations, stocks typically do very well and earnings typically do well. Earnings revisions have already traded higher, which suggests that the S&P should be up. Now, earnings revisions have already bounced back to the highs of the year. And so it should not be surprising to many people that we've seen this, but to show you other relationships, this is the S&P overlaid with that global revisions number. This is through yesterday. So we have seen the S&P basically followed up. So if revisions continue to be on the strong side and we're entering earnings period now, I would suspect that you're going to continue to see pressure on equity markets to go higher at a time when sentiment is still low. This is that relationship between the economy and revisions. This is U.S. Revisions is the white line, and then it's overlaid with the PMI. So you can see that as you get this kind of two-horse race upside of revisions surprising and economic data surprising, you usually get a positive aspect to the market. One area that has surprised me so far, and I still believe it's going to be a place that goes, is the weakness in value, which has not participated. I'm going to show you some reasons why I think that is continuing. This is the example. The white line here is the cheap side of value relative to the S&P. So cheap names have not, they barely bounce relative to the S&P. This over here again is the global revision. So typically when you see revisions start to spike higher, you see the white line go higher. A lot of that has to do with beta sometimes, but also with these companies being economically sensitive. That has not happened now. And when I look for a reason why, this would be the one thing that stands out that is not moving. And this yellow line here is 10-year rates in the US. So this is versus the PMI and versus earnings revisions. So when you have earnings revisions and PMIs going higher, historically rates have been moving higher. In this case, 10-year rates have not budged. The chart looks a lot like the value chart, so it's having an impact. The one thing about value, when you go through it, there were a lot of things that were driving it over the past few years. One of it was obviously energy and materials. So you had the commodity-based stuff, which was keeping it down. That has changed now. A lot of the commodities have gone higher. I'm going to show some charts on that later. We've seen a bid to the materials names. Energy names have definitely hung in there better than the value index. So the question is, what's keeping this down? And this is a chart with the yellow line being that cheap names versus the S&P, the orange line being value, and then the white line here, which you look back, has been correlated to it. That is the banks relative to the S&P. So banks have become an important part, and the reason is because their market cap is so huge. This is BKX relative to the S&P, and this is overlaid over the course of this period of the growth versus value trade. And growth versus value continues, and this is inverted. Growth versus value continues to head back towards the highs, and I think the major reason on this is that the banks have not, as of yet, been able to outperform the S&P. The other surprising factor that has shown up is that normally when you see revisions go higher, which again is the orange line here, you generally get a movement in sentiment. Now this is the last 10 weeks of the AAII net bullish bearish reading, and it's basically barely budged. So we're at similar levels to where we were in March of 09 and in 08. This is after Bear Stearns, this is after Lehman, this is obviously in the energy crisis. We can't get any kind of bid in sentiment. And a lot of that has to do with the fixation, again, on the cases number in the US, which I think is continuing to cause PTSD for investors in terms of getting worried that the same thing will happen. This is that net. Again, this time I'm taking the 20-week average just because we've been negative for 20 weeks in a row. And this is overlaid with the PMI. So the PMI goes up, we're not getting a sentiment change. Again, this is not normal to see sentiment stay at these low levels given the facts that are happening. And I think one of the things that has confused people when they're looking for an explanation is just the continuance of what money is out there. So again, this has now been updated. This is the last 15 weeks of M2, the rate of change. So it's grown at, again, 17%, not seen in history. So you have M2 growing. You have the savings rate, which did fall as people spent money, but the problem is we're still up at 23%. And what that means is there's a tremendous amount of buying power out there for spending money, but also for putting money into the market. That also shows up on this one, which does not get enough attention in my opinion, but this is the money market assets. And again, this is over the last 20 weeks. During the 20 weeks where I showed you that sentiment has stayed negative, it matches up with what has happened with money market assets. So money market assets are actually sitting up here. Now in 09, when we made the lows in 09, that was also around the peak in money market assets where they started to drop. In this case, we are still sitting with a tremendous amount of money that has moved into zero yielding instruments. And so that money is gonna move out in the curve. And at this point with where treasury yields are, I think they're just going to continue to focus on putting money into the market on any kind of dip now that they have the support of the economic data and the earnings revisions. I just wanted to bring this up because on this M2 and this concept of modern monetary theory, which I will continue because I think the jobless rate is going to stay higher than where the government wants it. So the economy might be bouncing back, but I think a lot of this is going to show up into profit margins for companies who are going to have pricing power or figuring out how to make their business more efficient and are having an economic backdrop which is stronger than what they expected, leaving inventories on the low side and having to do a lot of stuff, which I think over the next 2 months will be surprising. Just to put that in perspective, there was a lot of indications of hoarding going into the tariffs into the fourth quarter of 2018, which kept the PMIs extremely high into the fourth quarter of 2018. I think we're going to see a similar example of companies needing to take in inventories, worrying about supply chain impacts from the second wave thoughts, which would be in the fourth quarter when the wintertime comes. This is just the trade deficit. So I mentioned this on the last time, the trade deficit came in, we're now at, not the trade deficit, this is the budget deficit, which is now at minus 9.8%. This is gonna get worse in coming months. This is it overlaid with the dollar. So I think the dollar weakness will be a big story, which again will have implications for a lot of different things in terms of changes in assets and the reflation story. One place where this is new data for people to make sure they're watching is in China. State media reported this week that China wants the stock market to be a bull market, believing that that is going to help them with the trade situation breaking down and countries needing to be dependent on their domestic economy. China is focusing again, it appears to be on the stock market. So we've had a violent rise in the last 4 days, which is breaking through the highs of last year and is quickly approaching the highs of the last 5 years or 4 years since this bubble that they had. Now, this thing was a similar type story breaking out. I'm just showing it to show how fast when China moves that this can move. You've seen volume there, you've seen account openings. This is the NASDAQ China name, so this is the CQQQ breaking through the highs of 2017, following what's happening with inside the local market in China on the Shanghai Composite. The area that I would focus on gets back to what I said on the value versus growth trade. China has obviously large market cap in the banks, and if we see the banks in China move, you're probably going to see this be an important point. The white line here is Asian banks. They've broken out above the prior highs. The orange line here is global banks, which have not gotten through that high. This is because of Europe and the US. If China continues to have a stock market move higher and continues to see better action, I think you're going to see a lot of movement in US banks as well. And remember, US bank earnings are coming up. I would watch to see how they trade during the bank earnings. This white line here is a commodity index that I've created to kind of use when we have an economic and reflation combined move. This is an equal weighting of lumber, copper, crude, silver, and gold. So you see where you get the economic side from the lumber, copper, crude, and you get the silver and gold. They're all synchronized and moving up higher here. The orange line there is the Asian banks. So whenever we have a reflation story, it's generally very good for China. So I would watch that to see where it's going. And again, this is the relationship between Asia banks and the BKX. So if Asian banks are trading higher on the reflation story, you're going to see US banks follow as well. At least that would be my expectation. So that would be a surprise place to watch for. This is just to show that also as the stock market has gone higher, the currency has strengthened in China. So we've seen a breakthrough the 250-day moving average in China on the yuan over the course of the last 48 hours. At the same point, we've seen a similar break in the ADXY, which is the Asian dollar index. So I would continue to watch to see how those go. It looks like there's a Asia reflation story playing. The importance for this is the orange line here is that ADXY, the Asian dollar index. What hasn't joined yet is the rest of emerging markets, but that is where I would expect the next surprise to be from. The white line here is the JP Morgan emerging market FX index. So we haven't seen it follow yet, but I would expect that if the Asian banks are going and we're getting these commodities to go higher, that you will see that go. One of the more important breaks, and I'm going to end this on this note, this is the EEM versus the S&P. It's obviously been in a down move. I've been positive on emerging markets for some time, and it has not played out relative to the S&P and in particular the NASDAQ. EEM over the S&P broke through the 250-day moving average. You can see that the last time it was above it was in April of 2018. This is the longest period in the last 20 years that we had been below it. People in general are negative on it. I would continue to watch EEM over the S&P, watch the FX market and emerging markets. This would be the surprise area that if I was rotating assets based on what's happening economically from a surprise basis, what we're seeing in earnings revisions and what we are seeing right now from China, I would expect that emerging markets are going to have a tailwind that's going to happen with commodities, China, the dollar weakening. I think it's all going to spread into emerging markets. And given the S&P is already close to all-time highs, it's time to start looking for some of the laggards and looking for groups, particularly as we go through the earnings. So that's it on this webinar. Obviously, if anyone has any questions or would like to discuss any of the charts or anything there, reach out to the marketing group. You can reach out to myself as well. That's it for today. Thanks.
Thanks, everyone.